Hey, this is Andy Mandel with the Mandel team at RE/MAX, and today we're here to talk about a few of the key terms on a contract that you're going to want to understand when it comes time to purchase a home here in South Florida. Okay, so the first term we're going to go over today is inspection period. So the way the contracts are these days, just about everything is being sold as is. If the property is in worse condition, you're probably going to get a better deal on it. If everything's super upgraded, it's probably going to cost you more money. But all the contracts basically are as is, so no repairs are going to be done. The way the contract is worded, the buyer has the full right to inspect the property. Typically in our market, it's between 7 to 10 days to do your inspection. That's more than enough time to get an inspector out there. If you don't like the property, if you just change your mind during that inspection period, you come back out of the contract. There's no risk to you. So there's never any risk in putting in an offer on a property that you're interested in. Once the inspector gets there, they're going to do a full inspection on everything in the house. So roof, AC, plumbing, electrical, the pool, the sprinklers, all that kind of stuff. You're going to get a full report and know exactly what's wrong with the house. Anything you're going to want to address and fix going forward. If there's anything major that needs to be fixed,
roof leaks,
AC doesn't work, plumbing leaks, things like that, what we typically do is we get a credit from the seller at closing so you as the buyer can fix it after closing. The reason we do it like this instead of having the seller fix it is because the seller's going to want to fix it cheaply and quickly, and you as the buyer, you're probably going to want to make sure the work is done correctly, maybe by your electrician, your plumber, whatever it may be. So this way we make sure that you can do it the way that you want to do it. The next term we're going to talk about is appraisals. So when you're getting a mortgage, the bank is going to order an appraisal. That's a third-party company, completely unaffiliated with the transaction. They're going to come out and take a look at the house. They're going to compare the location, the condition, the view, anything that has to do with the property, lot size, things like that, and they're going to compare it to other homes of the same square footage, give or take 10%, in that neighborhood specifically, that have sold in the last 6 months. So they're going to do their own kind of assessment of the value of the property, and they're going to come back and tell you what they think the property is worth. So if you write an offer for $350,000 on a home, let's say, and the appraisal only comes in at $340,000, what happens? So there's a couple options. Either the seller can come down to the appraised value, which is what we try to fight for, because why should you as the buyer pay more than the property's worth? The next thing you can do is agree to pay more than the appraised value. So you could say, I know it only appraised for $340,000, but I want to give you more money in order to get the deal done because we just love this house. And that's an option too. Or you can meet anywhere in the middle and figure out a deal. If no deal can be made, you can get out of the contract as a buyer. Everyone can cancel the contract. You get your escrow money back. Everything is good. You walk away and you try to find a new house. Escrow money is the next term we're going to talk about. So when you go to buy a house, you have to have a down payment. And when you go under contract with something, you have to put part of that money in escrow with the title company. It's a third-party company that does all the paperwork for the sale. So typically a strong down payment would be, or a strong escrow amount would be 3 to 5% of the purchase price. We try to shoot for $10,000 to $15,000 depending on the size of the property. That shows you're a more serious buyer and your money is never at risk. So the only way you could lose this money is if you don't close on the house. If you change your mind halfway through and you break the terms of the contract, then you are at risk of losing that escrow money. But if you do everything that you need to do to close on this house, your escrow money is safe. It goes towards your down payment. So if you needed $20,000 total to close and you have $10,000 in escrow, at closing you just bring that next $10,000 and you're good. The next thing we want to talk about is the loan approval date. So they changed the contract. This is very important. They changed the contract in April of 2017. So you have 30 days now, if you're getting a mortgage, to get your full mortgage approval. If you don't get your mortgage approval in 30 days, you are at risk for losing that escrow money. That's why it is extremely important to use a mortgage lender who you can trust, who's local in the area and has a good track record of making sure they close on time. If you need a good recommendation for people, we have a few lenders who we work with here. I'd be more than happy to recommend you someone good. But the reason why we recommend certain lenders is because they do a fantastic job and they make sure you are fully approved up front and you will never have to worry
about the risk of losing your escrow money.
So I hope that made some sense to you. If you guys still have any questions, feel free to give me a call, shoot me a text, send me an email, whatever you prefer. We're always available here and we look forward to hearing from you.